Before we can create a better system, we have to believe that another system is even possible. To do that, we need to look at what money does for us, what purpose it plays in our lives, what it does well and what it doesn't. This can be done by asking some fundamental questions about the role and purpose of money. First, what is the one essential purpose of money for which there is no substitute? Buying the things we need and want, right? Direct barter is so cumbersome, and money so versatile and convenient, that money in some form must be considered a necessity for any kind of complex economy. But, except on rare occasions, most of us don't need money to buy gold or silver or real estate, the usual things money systems have been based on. This leads to question 2. Why can't money be backed by all commodities instead of a single specific one? Wouldn't that completely change the nature of money and liberate it from the model where money's value derives from its scarcity? Question 3. Why can't the supply of money be created directly by the day-to-day need for money? If that were the case, the demand for goods and services would create the supply of money needed to purchase those goods and services. Question 4. You have to spend money to make money. Now that's a familiar saying that points to the other essential purpose of money, which is to fund future production. Question 4 then follows. Why should money be a claim on existing things at all? Why can't it be a claim on things yet to be produced? And finally, question 5. Can we set the bar higher and make money inherently stable and intrinsically moral? Is it possible to create a money system that balances and corrects itself automatically and distributes wealth more fairly? The answer to all of these questions is to eliminate money as a single uniform commodity. Instead, money should be a promise of or a voucher for a specific amount of any actual thing in demand, whether it exists already or will be produced in the near future. Money would then cease to be a thing in itself and instead be simply a unit of measurement for the value of real things, like minutes are for time, meters for length, and tons for weight. This idea of vouchers for real things goes all the way back to the invention of writing in numbers, and probably preceded the widespread use of coins. But until now, it was only practical for limited and local use. Our advanced technology, at long last, makes this concept practical for global trade. And there is a growing use of trade vouchers for real products already happening in business-to-business barter networks around the world. Once values can be reconciled by a common unit and transactions carried out using modern technology, there's no longer any need for money as a single uniform commodity. Most money is already just accounting, not a physical thing. Credits used as money could, and probably would, still include vouchers for gold, silver, and taxes. But they would also include vouchers for food, clothing, shelter, services, in fact, anything in reliable demand. Money has no value if there's nothing to buy with it. This should be obvious. Therefore, the logical source of money should be the value of the real things we're going to buy with it. That value is ultimately determined by what the customers are willing to exchange for it. Therefore, value is created by demand, and money should be also. In the bank credit system, money is not actually lent. It's created by the borrower as credit towards demand for the borrower's future production, just as this movie is proposing. But the system pretends it's a loan of money, and repayment must be in money. The borrower, is required to earn both the principal plus the interest in money within a limited time. The alternative is to create credit money directly and simply spend it into existence in the process of production. Like bank credit, this is credit towards the demand for future production to be honored within a limited time. But the credits spent in this system are obligations to be fulfilled with products or services only. There is no debt of money. Full recycling is naturally enforced by the system itself. The money created to produce something must equal the money needed to buy it when it's ready for sale. If this seems novel and strange, that's because the words used in banking have conditioned us to believe that banks lend money. In truth, we self-issue credit now by signing the loan document and pledging our future productivity to repay the so-called loan. Our promise of repayment in money is what creates the money. And most of us will have to earn the money we repay by producing real goods and services of value to our fellow humans, just as if we had issued our credit directly. In our current system, the bank doesn't actually have the money it creates for us. The bank does, however, validate our self-issued credit by undertaking to lose the amount created if the loan is not repaid. This is called an unfunded liability, a fancy term for gambling money you don't have. Thus, our personal credit becomes both the bank's source of income as interest and also a potential loss to the bank. As the bank increases its income, it also increases its potential losses, which it knows it cannot cover. As banks are only required to own assets that cover 4 to 8% of their potential losses, losses more than that will put the bank out of business and require deposit insurance to bail out the failed bank's depositors. Like the banks themselves, the deposit insurance can only cover a small proportion of its potential losses, so the burden of saving the system eventually falls on the general taxpayer, the only one who can be compelled by law to take on the bank's gambling losses. The public as a whole must go into debt to create the new money needed to make up for the private liabilities that were unfunded in the first place. We can go on endlessly about the numbers and who did what, completely missing the point. The problem arises because we are enmeshed in imaginary numbers generated by an inhuman, unnatural, and ill-designed system which has become completely divorced from reality. All payments to the bank must be made in the form of bank credit or fiat cash, unforgiving numbers. So the first difference to note between our proposal of producer-issued credit money and bank credit is that where bank credit is payable only in money, self-issued credit is payable only in goods and services. In the first case, if the bank credit borrower fails to pay the bank principal plus interest in money, the bank takes whatever was pledged as collateral. Neither the bank nor the borrower has any means to ensure there is enough money in existence for everyone to pay back their bank credit. And neither party has any control over the value of the collateral either. The collateral may plummet in value and be insufficient to cover the bank's liabilities, causing a book loss and threatening the security of all the bank's depositors. When severe and widespread, this structural problem can bring the entire economy to a screeching halt in mass bankruptcy. By contrast with self-issued credit, it's impossible for the promisor to go bankrupt. Why? for the very simple reason that there's no debt of money to a bank. The debt that creates the money is payable in goods and services only. Therefore, a promise of product or service requires the ultimate creditor to purchase from or hire the one making the promise. Now, it would always be possible to be unpopular, unproductive, and unemployed. That would render an issuer unable to issue credit anymore. No one would accept it. So one could indeed go out of business. But with self-issued credit, going bankrupt and losing assets pledged as collateral could only happen if the issuer breached its credit contracts by failing to deliver the products or services promised. The supply of these the credit issuer should have control over. Poor business usually results in excess product, not a shortage. Therefore, a failure to deliver on promised production would have to be the result of some exceptional circumstances. It would not be the normal situation.